Guys, so much for having me. My name is Jake Wujastyk. I'm one of the founding members of TrendSpider. We are a technical analysis platform, so anything ranging from automated trend lines, dynamic alerts, back testing, screening. Pretty much you can do everything except make a trade through TrendSpider, and that will be coming as well later this year and early next year. So what I wanted to do today was go over something that, people know about, but maybe not know about this particular strategy. So everybody's heard probably of volume by price or the volume profile, whatever you'd like to call it. And essentially that's what we have up here. We've got the volume profile shown, which are all these bars on the right-hand side. And generally, when you have when you've got a volume profile up on different platforms, generally it's very hard to be able to really localize these supply and demand zones, because if we scroll back, each one of these moves is like a status quo, meaning the price hits a level, the price drops, and the status quo changes. So that is kind of the first process of learning how to use this, is anchoring the volume profile. So generally, if I was scrolled back until December 20th, the volume profile would start here, because it's a function of time. And so you can see here, volume profile would start right where this line is. And so it would tell us any volume that's come in since this period of time. You're essentially measuring where that distribution of shares is within the price level. So, for me, why would I care about December 19th, 2019? There's nothing special about this date. We were in an uptrend and we continued in an uptrend. So what I want to do is I want to find parts of the chart that have these status quo changes. And so the first one that obviously I'm going to go over today is the February 19th reversal that really started this whole waterfall. And so what you'll see is, when I start the volume profile from this particular point, and notice if I, let's say, moved it over, the volume profile is going to change as I move this line. So I just want to start it from this particular point. And what you'll see is something really interesting, even going on right now in the market. You can see that from this point in time, most of our volume is holding right around the 252 to 259 range. And so when we gapped down yesterday, this area became a supply zone, because the price was then trading under this volume rather than right at it or above it. So what you'll see here is, notice when the price started to drop down, we didn't have a lot of volume holding in this little volume gap. So you'll see here the supply sticks out far to the left, the demand sticks out, but then we've got this little kind of air pocket that didn't have a lot of supply and demand here. And that's why the price has been able to move so freely through this area, because there's not a lot of friction going on within the back end economics of this. Notice our range today. Notice that we opened right around 249. We tried to move up, hit the supply zone, and then literally moved down to the demand zone, popped, and now we're trading within this air pocket. And so it's really cool to be able to see how the price is essentially just respecting these areas of where volume is holding. So anytime the volume bar is going to be below the current price, that's going to be your demand zone, because that's where people bought the stock, whether that's SPY or whatever. That's where a lot of people are breaking even. So as the price starts to move back down towards this demand zone, anybody that was holding a profit up here that originally bought the low 240s is essentially back to break even when we get to this demand zone. So anybody that was selling at a profit up here has stopped, because they're now break even. So, as Jim was mentioning in the earlier presentation, it's all about participants. It's all about seeing where those participants are on the chart. And so here we can see there's a lot of participants above in the 250s. So if the price did continue back up into this supply zone, remember, most people, based on this particular volume block right here, this shows that most people are holding at a loss right now. This is our point of control, meaning this is our biggest volume bar since February 19th. And so if we did get back and start to move up towards here, this bar of volume is now breaking even. They're now right now holding at about a $9 loss per share on SPY. So if the price starts to go up, there's going to be people that come in and start to add supply to the market because they're breaking even and they're like, okay, I'm out of here. For whatever reason, whether that's because they're too leveraged at somewhere else, whether that's just because they want to go all cash during this crazy time. But these are the areas at which you'll see supply. And then if we highlight this main big bar here, notice we almost perfectly touch that area below today as a demand zone. So if we go to the monthly chart, I want to kind of show how this works. This is SPY in the monthly chart, and I'm going to get into a little bit of off topic, but that's okay. But what you'll see here is, notice that if we anchor the volume profile, and generally you want to anchor the volume profile or anchor anything from a status quo point. So the reason why I'm starting the volume profile at March 2009 is because that was our capitulation candle for SPY before we ended the financial crisis of 2008 and 2009. So that's why I'm starting the volume here, because this is when everybody capitulated. This is when supply and demand reset. And this is when the trend actually started to the upside and really hasn't stopped until recently. So if we look at this long-term chart, we technically haven't even stopped the uptrend, because we did break down through this long-term support, but then we did pop above it. However, notice that we did open below the previous close. I'm never a huge fan of that. Generally, if you've got something like that, from just experience, I've seen the price kind of follow this wick back down. We'll see what happens. I'm not short the market here. I'm not really long the market. I'm just kind of observing, taking trades when it makes sense. So the reason I brought this chart up is, notice that, when we were way up here, notice that the price, where we were, the average person was holding, here, and they were holding way down here. So that means the average holder within these volume blocks was holding at a 55% return in, just under 3 years, which is pretty good if if you're looking at your retirement account. If you were holding way back from, the initial drop from the European crisis in 2011, 2012, you're up 140% in 4 years, or excuse me, you're up 140% in about 7 years. So, there were a lot of people holding profits from these particular areas. And so what happens is, enough people are holding profit and enough of a shock comes to the market like the coronavirus, all of a sudden you've got all of these people holding at huge profits starting to exit at the same time, and enough people start to exit at the same time, and enough people kind of back off of the market on the demand side, you get these massive drops because you're essentially just having supply and demand reset. If you look and see where we bounced, notice what happened here. We literally almost bounced right off of this demand zone here. And so remember, at first, these people were essentially up from this point. They were up over 60% in less than 4 years. And so, as soon as all this comes out, they're all racing, to get out. But as soon as the price starts to move towards this demand zone below, or we can even call it a break-even zone, notice how the supply dries up, because now everybody who was selling for a profit is now back to break even. And so this is really important to understand, because the market is simply based on psychology and supply and demand. And so if you're able to kind of hone those two things in and understand, where supply and demand levels are and the psychology behind it, it will give you an edge in the market. And that's really what this market's about, is getting an edge and trying to figure out, what tools out there can help me kind of see things that other people might not be able to see on other platforms. And so this is something that is completely unique to TrendSpider, being able to simply visually move this without having to do anything, whether that's going into, the back end and actually putting in a specific date. There's no need for that. You simply just move the line in whatever candle you're at. That's where the volume profile starts. So notice here, we bounce right off of this, right above this break-even zone, and then notice how quickly the price was able to move back, and notice where it moved back to. It moved back to this supply zone above. And so all of these people who bought in early, all of a sudden are like, all right, I'm getting out. I'm finally break even. And so they're the ones that then add to the supply on the market. And then that's why you've got, essentially we closed right at this level, and now we're back down after the unemployment numbers. But we are holding pretty well. I mean, if you look at the daily, we do have that pretty strong demand zone below. We've got that volume gap that is really acting as kind of the main area right now for price to trade in. But, it's fascinating. I mean, look at how well the price is respecting these two levels just today. As I showed on the chart, this supply zone is, this is simply a function of just this one bar. Generally, I'm going to highlight like the top 3 or the top 4 volume bars here that act as supply, because you're not going to just have one level that acts as perfect resistance. But if we highlight this general zone, notice where we caught caught some supply above, right at that volume block here. And the volume gap simply just shows us how quickly we were able to move down, because it was kind of an air pocket right down to this next demand zone, which acted as a decent demand zone so far. One thing that I like to do is also add the anchored VWAP to this in conjunction. So the anchored VWAP is something that was created by Brian Shannon. He's the founder of Alpha Trends. This is essentially the same thing that I'm using on the volume profile, except now I'm anchoring the volume weighted average price. So being able to use the volume weighted average price and use the volume by price at the same time really gives you an edge, because notice here, look what happened. The volume by price actually failed yesterday. Obviously, it didn't fail, but there was a little bit of a margin of error around it. So what you're able to do is you're able to see, okay, well, we're right near the anchored VWAP, but we're bouncing right off this demand zone below it. And so being able to use these two things in conjunction are really what's going to give you an edge in the market. So, this is a great example of, VWAP failed, and then you've got the demand zone below that picked it up, and now we've got a nice move up. As much as the unemployment numbers suck, I think a lot of people, the market's essentially pricing this in as a temporary thing, and that's why, we're not crashing today. As much as this is just absolutely crazy on the unemployment number side, you have to think of the psychology thing at this side, where the market has already priced in a lot of bad things happening. So you can only get so far within pricing in stuff before you come out a week later and the market's already kind of anticipated that happening, and so there's really not even a reaction to it, and that's kind of what we're seeing today. Even though we did absolutely blow through expectations, I think the market sees any type of unemployment numbers right now as maybe not something that's going to last. And that may be why we found some demand down here as well. But just from a basic demand zone, people were, back to break even, supply dried up, and we've got that move up. Simply just supply and demand and equilibrium pricing. I want to go through a real life example of a trade that I made last week on GE using this tool. So you can see here, I did 2 different things. I anchored the volume profile from this March 3rd kind of dead cat bounce high. Notice that we hit an intra, this is the 65-minute chart. So we hit, an intra 65-minute high here, and that's where I started to anchor it from, because we were already in a downtrend. We had this little bounce. We tried to, make a higher move here. We didn't, and then we continued down. So this is kind of the status quo point that started the next leg down in the trend. So this is where I start the volume profile. I want to start the anchored volume weighted average price from this big gap down. Generally, you want to anchor the volume weighted average price. I was taught by Brian to do this at status quo levels. So essentially, I'm using the same type of thought process on the anchored volume by price as I am with the anchored VWAP. So here, it sometimes pays to not have the anchored VWAP and this anchored volume by price the same area. So here, this is an example of using two different areas. Notice what happens. We finally break through this anchored VWAP here, which did act as resistance in mid-March. Finally broke through it. And notice what we've got here. If you guys remember the SPY chart, we've got that big volume gap right here. We literally have very low volume holding until this next level above, which is a supply zone. So naturally, we've got this little flag forming. So I jumped in. I bought 2,500 shares at I scaled in. So I scaled in, I think, from the 770s up to even the high 780s. And so as the price was going up, I was scaling in. The next shot shows a very quick move up to the price target area, simply because there was not a lot of friction here. There was not a lot of supply above. And so notice the price literally goes from 780, here's our target above, and within less than 60 minutes later, we've got this huge impulse move up. I just simply stuck to the plan. My target was right where we showed it here. I exited, I started scaling out at 817, and I sold my last tranche at 828. So, if we go to the next shot, this was a heavy supply zone. This is where people were breaking even, and they're like, okay, I'm back to break even, I'm getting out. And so that adds to the selling. And then notice what we've got on the next picture. We've got a perfect respect of this supply zone. Notice how the price is able to move pretty quickly back down through this gap. And then we've got the price continuing to move down. And then we actually moved down all the way to the low sevens, which was right around this volume weighted average price and also this next demand zone. And so if we go to the current chart on GE and we go to the 65-minute candle, we'll kind of see what's currently going on there. Let's see, I may need to do a little bit of stuff here. Anchor it from this point again. And exactly, you'll see, where did price catch a bid? If we kind of zoom out here and we highlight this area, boom. If we start the volume profile here and we see where all of that volume is holding, notice that the price caught a bid right at the point of control. If we anchor the VWAP from this low here, notice that we're trading right at this area as well. So being able to use these two things in conjunction is really powerful. It gives you an idea of not only kind of what the equilibrium price is from a particular point, which would be your volume weighted average price, but then you can also see where these supply and demand zones are holding around this area. So notice here, this volume weighted average price was not the perfect zone. We needed this demand zone below to tell us that there was a lot of people holding here. It's kind of like, this is a weird example that I always give now, but it's kind of like jumping into the Dead Sea, right? If you consider this big block of volume the Dead Sea, if you dive into the Dead Sea, you can only go down so far because, the whole buoyancy factor and all the salt in the water pushes you right back up. And it's the same thing here. There's so much demand here. When you try to drop the price, there's so much demand that it just pops right back up. So that's kind of the way I look at it. Notice how the price is really catching a bid here. I may even, enter GE today because of this. So definitely something to keep in mind as far as kind of being able to use these things. The reason why I'm using the 65-minute candle here is simply because there are 390 minutes in a trading day. 65-minute candle allows you to have 6 even candles rather than having a 60-minute candle that you're not going to have equal bars for the whole day. So that's the reason I use that. I also learned this from Brian. Brian's one of the main mentors that has really taught me about anchoring, about using these time frames. And so and that's where I've been able to acquire a lot of this knowledge. So that's an example on GE. Nice bounce right off this demand zone, point of control, if you want to call it that. If we want to really identify the point of control here, it's this volume bar right here. And reason why is it's simply the biggest volume bar that's sticking out to the left. And then notice where price was able to catch a bid here. So, this is not coincidence. This is simply supply and demand playing out. So let me go to another example here. This is Roku. This is an example of Roku on the monthly, or excuse me, the weekly chart. And what you can see here is the same exact thing. If we anchor the volume by price from the IPO date on September of 2017, notice since the IPO how the price has really respected these areas. When we really started breaking down, notice how the price was able to quickly drop through this volume gap. Notice that it bounced right at this demand zone, very similar to what we just saw in GE. And then notice what happened. The price then bounced within a week right back up to that supply zone. People start breaking even and they're like, oh, I'm out. And that adds to the supply. Supply starts to outpace demand and you've got your drop in price. And so now we're trading right between this demand and this supply zone as the as the price tries to figure out what it wants to do. If I anchor the volume weighted average price from this December 2018 low, which was essentially a low in the whole market, notice that this anchored VWAP is right here at the same exact spot as the supply zone. And what you'll notice is, notice that using the volume weighted average price and the volume by price in conjunction allowed us to see that, okay, the price didn't necessarily hit the volume weighted average price exactly, but what you could do is you could go in and you could create an alert at the volume weighted average price. And rather than being alerted right at that line, you're able to increase the sensitivity or the margin of error around this line. And notice that we would have actually been able to capture this supply zone with this sensitivity alert. So anything within this purple area, anytime that the 30-minute candle closes within this purple area, I will be alerted. So it gives you the ability to, not have to be very precise. The market is not precise, especially in a time like this when you're getting, liquidations, you're getting just all types of variables thrown in the picture. This is when you want to have some of that sensitivity. So this is an example on Roku. This is the weekly. This is probably my favorite example on United Airlines. Notice here, we capitulated in July of 2009. This was our low, and that's why I started the volume by price here. So notice what happens. We capitulate. I start the volume profile here. We capitulate up here. Notice where the price drops to. Literally right to this demand zone. And the same thing. There were so many people holding at a profit from this particular kind of consolidation zone. They were up from this, let's just do an average in the middle here. From October 2011, people were up on this 400%. So if there's nobody supporting price up here, which there wasn't, notice that you don't have a lot of big volume blocks up here. They were down here. Notice that the price was able to drop almost in free fall because everybody at the same time says, okay, I'm taking profits. On top of that, people are panic selling simply because the airlines are in a hot mess. But notice where the price catches a bid, right where originally where all of these these shares are distributed at 17 to 25. I mean, if you look at this wick, you'll see how perfectly the price respected this demand zone. And this is not by coincidence. This is simply economics playing out. When you get to a point where demand is outpacing supply, the price goes up. When you get to a point where supply is outpacing demand, the price goes down to kind of factor in those variables and to get back to an equilibrium price where the supply and demand are currently, where they're currently at this point. So as people started taking profits, as people started saying, okay, well, this is sketchy, I'm getting out, you add so much supply to the market. And then once you finally get back down to, you can either call this the demand zone, or at this point, I kind of like to call it the break-even zone because we don't really know it's going to be a demand zone until after the fact. Because, right now, obviously it did act as a demand zone, but we can also just say this is where people started to break even. And that's why the supply dried up. People are like, well, I don't have any more profits. I'm not going to sell now. I'm just going to hold. And some people, when they break even, sometimes are even like, oh, well, I may even add a little more. And that adds to the whole equation of supply and demand. And that's why we've got, these types of moves. This is going to be interesting, right? We've got a pretty big volume gap here. We don't have a ton of shares holding from, from this previous demand zone to the supply zone above. So that allows price to move up very quickly. So, I personally don't think, we're going to move up that quick. I mean, the airlines are just in a mess and the fundamentals are kind of, taking over at this point, but technicals are still relevant. But you do have to, look at the fundamentals as well and say, well, I don't see anybody flying for anytime soon. These airlines only have so much cash before they're going to have to really get bailed out. So the fundamental perspective does come into these charts as well. But if we did start to move up quickly, that area of supply would be right around, let's say, 43 to 48. That's when people who maybe bought the dip a little early start to break even, and then they start to sell. So these supply and demand zones, both of them can also be exchanged for break-even zones. Anytime you've got the price below this block, it's your supply zone because this is where people would break even. And anytime you've got this volume below, it's your demand zone. So I know I've said that a lot, but it's very easy to kind of mix those up. What's the demand zone? What's the supply zone? Simply look at where the zone is relative to the price, and you'll be able to say, okay, this zone is below price, that's demand. This zone is above price, that's supply. And both of them are essentially where people are breaking even. And that's an important part of the equation. So, that is essentially what I wanted to go over today. That is the anchored volume profile. What I also want to go over is one more example of this, but I also want to go over raindrops, which is also something that's very powerful on the platform and has been able to give me an edge. Same thing here. You guys are going to get tired of listening about the anchored volume by price, but I'm telling you, it's one of the most powerful tools out there, used in conjunction with the anchored view app. But notice here, right? We've got the volume profile anchored from February 19th. This was pretty much the high across the board. But notice that we actually hit an intraday high that was higher than this original point on March 3rd. The reason why I'm not anchoring the volume by price from this March 3rd high is because if we go to a line chart, you'll see that the 19th is really when we did start to move down. So here, this is February 19th. This was kind of when the trend really started to go down. We hit a lower close here, and so that's why I'm starting it from this point. So if we go back to the volume by price, I want to anchor it here. This was our highest open. I want to anchor the volume by price because this was our highest intraday high. And then I also want to anchor the volume by price from this low. And notice here, if we anchor both of these, you'll see that the price respected this area pretty nicely, bounced, and then notice what happened. The price could not get through this supply zone. Everybody who started to buy the dip here since this time, they were down at one point. Let's say everyone's like, oh man, I'm getting a deal on Netflix. Not drop. They at one point they were down 19%. So as the price goes back up from this low back up to, this is a 31% move in 10 trading days. People are back to break even and they're like, well, I was down 20% on this. I'm going to just get out when I break even. That's your supply zone. That's why you hit resistance. People start to come out and say, well, I was down 18%. I'm now, break even. I'm out of here. And that's why we've had such a hard time breaking through this area because there's so many people holding here. So that's the anchored volume by price. This is something that is very unique to TrendSpider, being able to visually just move this. This is something that I use daily. As you can see, I'm using this in actual trades as well. This trade in GE took all of about an hour and a half to fully materialize, starting from scaling in, getting a full position, scaling out, and exiting my final tranche. So these don't have to take forever. It really just depends on what time frame you're in. This is obviously going to take a little less time on a 65-minute chart, than if you had this on the daily chart because the candles are just different time frames. The next thing that I want to go over is the raindrop. This is something that is really, really powerful. It's essentially, oh, CGC looks beautiful right here. It's essentially, something that allows you to visualize volume within a candle. So what I want to do here is essentially, get rid of all this. We don't need any of this anymore. If we go to the raindrop, you'll see something that's really interesting. You'll see that, essentially if we connect this to this and extend it, we've got, a trend line that's been tested 3 different times. So if we split the screen and we go to a regular hollow candle, looking at the same exact setup, you'll notice something that's really interesting. First of all, before I jump too deep into this is the raindrop, obviously. You've got 3 different candles. You've got a green, you've got a blue, and you've got a red. The green is simply when the volume weighted average price on the right-hand side is higher than the left-hand side. And essentially all that's telling us is whenever you've got a raindrop, you, instead of having an open and a close like a typical bar chart, you've got the volume weighted average price as your left bar for the first half of the period, and then you've got your volume weighted average price on the right side for the second half of the period. So it's giving us more of a general idea of what the volume average prices are rather than the open and the close, which can be pretty, random. So what I want to do here is I want to show you guys, we're looking at this candle right here. And so if we look at this candle, you'll see that on the hollow chart, notice obviously this is a very strong candle. I like it a lot as a hollow candle, but still it doesn't tell me, everything. But what I want to know most is I want to know when we did break through this resistance line, was there conviction by the buyers? Because for every breakout or breakdown, you need to have, buyers coming in and actually confirming the breakout, or sellers coming in and confirming the breakdown. But here, we can't see that. And sure, we can see what the daily volume was. I don't even have volume pulled up. One second. So you can see here, obviously, this particular day, you had a little bit of extra volume here. I mean, barely any, though, is pretty much the, very similar to the other days. But if you look at, something that's a little more important, which is the raindrop, you'll see something really interesting here. Notice that all of the volume is focused at the top of this range. So I already told you guys about the first part of this candle, which is the bars. The second part is the volume profile actually overlaid onto the day's range to show you where that volume was within the intraday action. So without having to go back and look at the 5-minute chart and see where these blocks of volume came in, the daily raindrop will tell you where that volume is distributed along this day's range without having to do anything. So notice here, we've got this wick. We've got barely a close above the trend line, but here, notice that almost every single share that was traded was above this trend line on this day. And then from there, we've got a really strong impulse move up, literally moved up 50% in the next 5 days. That's CGC. That's kind of a unique example just because that thing rips out of nowhere. But this can be applied to any stock, any ETF. Just looking at these volume gaps. Notice here on Netflix, if we go back to that supply zone, you'll see something very similar. Notice that, when we initially hit this supply zone on this candle here, notice there was no volume supporting price at this area. Notice that it was completely flat. So during the second half of the period, you can see this blob of volume here. That means that everybody that did buy shares or sold shares on March 24th, most of that volume, especially during the second half of the day, was focused way below where the high of the day was. So if you've got a candle like this where you don't have a lot of volume at the top of the range, it tells us that buyers were not really in control because they weren't supporting price at the top of the range. So notice here, this is a cool example of the opposite. We've got this kind of breakout zone. Notice we've got a lot of volume focused above the resistance line. But if you look at the wick, you'll see that the wick actually did not break out through this resistance zone. But you can see with the raindrop how much conviction there was by buyers above this line. And people will say, well, how do you know that wasn't sellers? And the answer is, well, of course it was sellers, because for every buyer, there has to be a seller. What we know is any seller that came in, their supply was absorbed by somebody with conviction willing to buy above this resistance line. And then that told us really that, you know, this was actually a strong move. You've got a little bit of a retest of this previous area of resistance acting as support, and then you've got your continuation move up. So, you know, this market is all about finding an edge. It's about kind of being able to identify different areas of supply and demand, where buyers and sellers actually are. And so that really gives you an idea of, you know, okay, hey, I'm not just trading blind. I actually have some tools that will tell me, you know, what's kind of going on. This platform is not here to replace what you're doing by hand. It's here to complement everything that you're already doing in technical analysis. So, you know, I just went over the volume, the different volume bars. But if you kind of dig deeper into TrendSpider, there's just so many things, as I mentioned at the beginning. You've got your automated trend lines, you've got scanners. So let's, you know, if we just go to a blank chart here, let's just go to Home Depot. And, you know, let's say that I'm a trend line guy and I want to look at, and I do like trend lines. I like them less than I used to, but they're still important because they become self-fulfilling. But notice here, I've got a blank chart, and without me having to do anything on my end, I just simply turn on the trends here and notice that the system automatically picks up some different lines. Now, there's a couple things about this. The first thing is the timestamp. You'll notice that the last time that we actually looked at the data and drew a trend line was based on this timestamp from March 27th. So the system has not reanalyzed this chart to draw other lines. So if we go and refresh, you'll notice that the system is now finding different lines based on all of the relevant information in place. And this is just one set of preferences. This is not like TrendSpider's trend lines. This is the TrendSpider's ability to automate your style. So let's say that you want to change your analysis type from original to standard. This is also going to change how the trend lines are drawn. Now, if I go from, let's say, standard to enhanced, that's also going to change how the trend lines are drawn. And then if I go to all or unfiltered, this is every single line that the system is originally finding. And then as we start to filter out the algorithm from unfiltered to more lines, you'll notice some of these lines disappear. Let's say that you want to really capture this kind of megaphone broadening pattern here. We're able to double click on these two lines. We're able to go to most relevant, turn off trend lines, and now I've got two lines where I didn't have to use any bias on my end. I allowed the system to essentially come in and just kind of be an idea generator for me. And so same thing, you know, this is my first step. You've got your kind of broadening pattern. Second step is to anchor the volume by price, the volume weighted average price from this capitulation bottom. You know, some people, we may do it from there. It really doesn't matter. But either one of these two, this is pretty much the two bottoming candles. And you'll see how well price is really respecting this area here. And, you know, this may be a time for, you know, a move to test resistance above. That's when you come in, you create an alert on the line, you're able to choose your sensitivity, and then, you know, you move on with your day. And when the price gets to this zone, you either take your profits or whatever your plan is. And then let's say the price breaks down through this anchored VWAP, you do the same thing. You say, whenever the price breaks through this on the 10-minute candle after 5 days have passed, I want to know. So this is a way where you can kind of set your resistance and support and then walk away. So if you buy a position now and you want to take profits at, let's say, 191, then you simply, set your alert, here, and when it goes off, you get a text message and an email saying that it's hit your point. Let's say that this anchored VWAP is your stop loss. Whenever the price breaks through this line, you'll be alerted that the price broke through, and then you'll be able to do whatever you need to do. So this is a very dynamic platform. That's just, the alerts. We also have the strategy tester. If you wanted to back test any type of strategy, you'd be able to do that simply by going in and doing whatever strategy you want to test. So as long as you know the logic, that's all you need to know. So in this case, let's say we're using lower indicators and we want to look at maybe the MACD. And we say, all right, well, I want to know what the average return is whenever the MACD fast crosses up through the MACD slow, and I want to know what the return is after 20 days have passed. I can go in, I can choose how deep I want to do this back test. Maybe I only want to go back 2,000 candles, and you'll see here, the average mean trade return is 2.23%. The number of wins has been 34, number of losses has been 15. So we actually have a lot more wins than losses on this particular back test. And you'll see, if I go up here and see on chart, anytime that the MACD is crossed, it will show us that on the chart. So here's our entry, and you can see right here, this is when the MACD crossed, and then our exit is simply just after 20 trading days have passed. So, that is something that allows you to look for these conditions without actually having to know how to code. All you need to know is the basic Boolean algebra and the logic, and you're able to create these complex conditions easily. And this is just one condition. If you wanted to go in and say, maybe you also wanted to back test, the daily, let's say, the RSI 10 crossing up through 50, that may also have to be a condition in the back test. So you can add as many conditions as you like and create as complex of a condition as you want without the need to do any coding. So that's something that's really cool. This goes to our back tester as well, our scanner as well. So let's say that you wanted to simply, do a MACD scan on the Russell 2000. You'd be able to go in, scan the Russell 2000 for a MACD cross. So daily indicator, MACD fast has crossed up through the daily slow. And what's really cool about this is we can actually choose the current candle. So that means that I'm actually able to say, as the daily candle is forming right now, I want to see MACD crosses that are currently in force, meaning that the MACD is currently crossing intraday, but it actually may not close as a MACD cross, but it's something that may be setting up. So here I've got all of these different symbols that are currently forming an intraday MACD cross. And so if we go up here, you'll see, the MACD just crossing here, but the day's not over. This may close way down here and this MACD cross may fail. So this is really for people who want to scan for patterns that are currently still in force, and you're able to kind of pick up on that before it actually closes. Same thing here. Let's say that you wanted to do, a weekly engulfing scan. You could go, same thing, and then we'd go to the condition, weekly candlestick pattern, bullish engulfing. It's right here. And then, I want to see which current weekly candles are currently forming a bullish engulfing candle. And so if we go to the weekly, you'll see, here's our engulfing candle. This body is engulfing this body. And these are all of the different candles that we have currently forming an engulfing candle. Sometimes you are going to get a couple weird ones, like this. This is technically engulfing because this body is engulfing this body, but it's not like your textbook engulfing like you'd think. So this really does take into an account the exact rules and that's why sometimes you'll get some of these weird looking ones. This is a really textbook one. So, these are all of the current bullish engulfing candles on the weekly chart. This is something that I like to scan for on a Thursday night, meaning I know that I've only got one trading day left, and I want to see kind of what the setups are going into Friday and what they could look like going into the weekend. So this is very powerful as well. And if you have any questions about any of this, definitely please feel free to reach out and ask me. My email is the general email is hello@TrendSpider.com. My email is jake@TrendSpider.com if you have a specific question for me. But we're happy to answer any questions that you have about the platform. There's a lot that can be asked about it, so we're happy to help you out on that end. If you do want to check out the site, see what we have to offer, TrendSpider.com. If you go to the product tab here, you'll be able to see all of the different things we have to offer. If you were interested in learning more about technical analysis before jumping into TrendSpider, you can go to our TrendSpider YouTube channel. It's just TrendSpider, and you can subscribe there easily by just clicking subscribe. This is my YouTube channel. I guess I wasn't subscribed to our TrendSpider channel. Whoops. So we have a ton of different videos. We've got a technical analysis series, and essentially it's about 12 videos right now that go over all different types of things about technical analysis. So you'll see here, this is the current list. We've got things ranging from, what's the vortex indicator? What's the RSI? How do you use volume? This volume in the stock market is one that actually goes over, the volume profile and actually comparing it to volume as a function of price, which is the anchored volume by price, and then comparing it to volume as a function of time, which is your typical volume bars that you see. So these can be really useful. Definitely check them out. Just TrendSpider Technical Analysis Series on YouTube. If you do want to sign up, definitely let me know, and we will be able to provide a coupon code for you. So please just reach out to jake@TrendSpider.com, and I'd be happy to get you set up with a free trial for 7 days. We do extend that as well. So if you do, decide that you need a few more days to test it out, we will extend that, and we'll also give you a coupon code when you sign up. So definitely please let me know if you're interested. I am going to keep the coupon code just privately to, let anyone who's really serious about this reach out. And definitely, if you have any questions at all, hello@TrendSpider.com for general questions, jake@TrendSpider.com for actual questions regarding this presentation or any of the technical kind of stuff that I talked about today. So, with that, I think that is my presentation, and I'll hand it back over to you guys.
All right, thanks, Jake. Great presentation. So let's see. Yeah, we have a few minutes left. If anyone has any questions, or Jake, if you have any,
I can go over. I can talk about this all day. So
okay.
yeah. So I mean, if I'll give a couple minutes for any questions that come in, but I can go over this all day. One thing that I do want to mention, this is more simply based on, kind of the weekly candle here, but I'm just going to drill into your guys' head about the anchored volume by price and anchored VWAP, because I'm telling you, I've been trading since I was 12 years old. Obviously starting out, a lot of people blew up their accounts. I was no different. I was 12 years old. I had no idea what I was doing. I really started trading more in, the financial crisis of 2008. I was in high school and I was trading with my mom, and we had some success. But, the reason I bring that up is because I've never found something that has changed my style so much. I used to simply be an RSI, Williams percent range guy. I would look at the Williams percent range, look at the RSI, and then kind of, see if there's any correlation there. Now what I do is I simply will anchor the volume by price in the anchored VWAP. So notice here, this is going to be a little bit different, and this is a new strategy on how to anchor this. So notice I anchored the volume weighted average price from our 2016 capitulation point. But what I did with the volume profile, or the volume by price, is I actually started it from this big megaphone resistance. Excuse me. Well, initially this is our first area of resistance, but pretty much where the megaphone started is where I start the volume profile. So what's really interesting about this is, notice that, the price initially, when we gapped down into this big demand zone here, get rid of this. So you can see here, when we gapped down during the week of March 9th, notice how the price moved absolutely crazy here because, there was so much kind of supply and demand at the zone, the market just couldn't figure out what was going on. And so if we actually anchor the volume by price from this bottoming point too, you'll see that, the price was trying to kind of move up to test this area, similar to what it's doing now. So what I want to point out about this is two things. One, notice the anchored volume by the anchored VWAP was originally support 1 time, 2 times, 3 times, and then tried to be a 4th time here. I mean, technically we broke down, but we did, close above it. So this acted as support once again. What happens the next week? We absolutely gapped down way below it. And notice what happens here. Notice that, when the price starts to try to make its move back up, notice what we've got here. A huge kind of block of volume acting as this supply zone. And so same thing, you've got your anchored VWAP, which is now acting as resistance. And then right above that, you can see how well this previous area of support is now acting as resistance. All of these people who owned SPY from 259 to 264, and this was really where, our next level of supply was, because notice that, in these areas, there's really barely any shares holding down here. It's very little amount of participants that came in and actually, bought down here. A lot more people probably capitulated. So naturally, as we try to move back up, these people who bought early, who initially bought in the low 260s and are now down 15% on SPY, as soon as the price, goes back from its lows to test, their break even, they're like, all right, I'm out of here, screw that. And so what you'll see is, you'll see that this area, supply started to outpace demand, people started to break even, they started to say, all right, I'm out of here. And all of those people that start to say, all right, I broke even, I'm done, they add to the supply onto the market, and then it becomes unbalanced, and that's when the price has to drop to meet the equilibrium price again. And so you'll see, if we were to see a breakout, we really need to break through this first level of supply. A bigger kind of thing that I'm thinking that happens is that, we possibly kind of try to pull back and retest this area that we formally tested. But, this is all about expectation. I mean, clearly the market is either, one, being just absolutely propped up by the Fed, or two, the market's just already priced in a lot of this bad news, and there's just nowhere else but, for the price to go. If we go back to this original chart that we started with, notice what happened here. We've got, same type of thing. We've got literally the, and I guess the candle was messed up. This is opposite now. But essentially we opened down here at 245, and now notice that it is really hard for the price to break through this supply zone because there are just so many people holding above. And so today, you're really going to want to watch this level around 252, because that's really where we start running into this very heavy supply above. And, this is really where, we start to test and see if there's actually conviction by the buyers here. Really cool example of the volume gap, just for the price to be able to freely move through this area so quickly, just because there's no friction. There's no supply and demand kind of causing that to have any friction. It just moves very freely in these kind of air pockets. Same thing here. If the price did find a bid here and it started to move back up to the 260s, if we started to break through, notice that we do have another volume gap right here. So if the price was able to, quickly move up back to the 260s, we'll actually make this a demand zone, because let's say the price is trading at 258, 259. These buyers are now in profit, and so these are technically our demand zone. And then our supply zone would move up here. And if we start to move quickly, there's not a lot of friction in at least where volume's distributed, until we get to the 274 to 280 zone. So the biggest thing is going to be for the price to really break through this current supply zone, which was acting as demand before. But these supply and demand zones can very quickly change simply based on where price is located. And this is just a really unique way to kind of look at where the supply and demand is currently holding. And being able to use that in conjunction with other indicators really helps you get an edge. So I think I'll stop there. I'll leave the last 5 minutes to answer any questions, and really appreciate everybody coming on. Back testing, do you give the risk reward ratio and hit rate? I'm not sure what you mean by hit rate. So the risk reward ratio is going to be a function of your position. So how, your position sizing, but generally the back tester will give you all types of information. So when we go to that tabular data here, let's just do this back test real quick. You'll see a couple different really important metrics. You'll see the performance, right? You'll see how is this MACD cross strategy performed against simply just a buy and hold. So it allows you to see, how this strategy performs versus just buying and holding the security from X amount of time. So it does give you, the data analyzed, 8 years of data, your net profit, your beta, your number of positions, your average losses, your average return, but it does not give the risk reward ratio. But I'm assuming down the road, when we do continue to improve this, there will be some type of conditions you can put in to mimic essentially an exact trade. So being able to put in what your trade was, what you're willing to risk, and all that. We're just not there yet with the back tester. Average profit per trade to loss. Okay, hopefully that helped with that. And yeah, no, the back tester is very powerful. I would highly recommend checking it out, especially in times like this, right? Like if you were to look at the VIX, we'd be able to back test the VIX and simply do just a condition based on the price. So, if we were looking at the monthly VIX and we wanted to see, okay, what is the return? So we do the condition and we go to the monthly here. And the condition is simply the price close is greater than 40, the constant value of 45. And so if we wanted to see what the average return was after 3 weeks, we can go and see, what that is. If we go here and we go and back test the entire chart here, you'll see on the chart clearly this has only happened 2 different times, and both of these were in 2008. What you'll see here, this was a monthly close above 45, and then after 3 candles, your return was negative 25%. Here's our next entry over a close over 45 on the monthly candle, and then after 3 months, a negative 37% return. So this allows you to kind of use these really historical moves to see, what's currently going on. Notice here, we recently just had a monthly close over 45. So this is our entry. And then this line right here is simply just mapping out the average return based on these 2 entries and exits. So it's kind of mapping out for us what we should expect based on the other 2 back tests. So clearly this is telling us, the VIX may drop within 3 months down to 36 based on these 2 particular back tests that also held true in the past when a close was over 45. So it's kind of like being able to use, in hurricane forecasting, if you go and look at their hurricane map, they're generally giving you a cone of possibilities, and that's because they're taking a bunch of different models, or they're taking